Welcome back to the Williams Real Estate Channel. Today we are running through the macro market update for July 2025. Few evolving events happening throughout the month, and some new data points have been released, so strap yourselves in. This is a jam-packed session today. Before we get into it, this is the framework that we operate within, the 18-year land cycle. Not only personally do I use this to invest in property, but I also use it for investing in stocks, commodities, gold, silver, exposure, such things. So it is the whole philosophy around my investing. Obviously, I can't provide financial or investment advice. This is my story. This is my thoughts. Take it with a grain of salt. There's other people that obviously dig into the 18-year land cycle further and use it for trading and so forth. So you can look into it further, but I use it as a framework to understand where we sit in the market. First, being on that blue marker, equivalent point of time, mid 2006. We're due for the markets to top out come late 2026. So between October to December 2026. Come 2027, it'll be well evident mainstream that we've entered the next downturn. It will be the next land-driven downturn. They'll call it something, as they always do. I'm sure it'll be called the Trump tariff reset, along those lines. But we use this framework to understand, okay, firstly, where do we sit? And then we peel back the layers and use it from a property perspective, because there's not one property market. In the first quarter, Sydney, Melbourne outperform. People then get pushed out into their respective regions. That's when we see the likes of regional Victoria, New South Wales, ACT, Tassie outperform in the second quarter. Come mid-cycle, people then decentralise interstate and head out into the likes of Brisbane, Perth, Adelaide. That's when we see those markets outperform in the third quarter. And then again, people get pushed out as prices rise into the regions. So then we see the likes of Darwin, South Australia, regional WA, regional Queensland outperform in the fourth final quarter where we are today. So we use it. We like to get in to markets before they go through growth runs. So it's not necessarily the markets such as Brisbane, Perth, Adelaide, Darwin, and their respective regions that are the markets we're buying in today. We were getting in those markets 5 years ago. Always be ahead of the curve. So the point of this update today is to show you how we are on this blue marker and how I see it all playing out over the next 12, 18 months to 2 years, as the data points can be correlated to allow you to see where we sit, and you can be reassured that it will provide you clarity of where we're sitting and where we're heading. And obviously there's a lot of noise out there, what way the markets are heading. And as we go through this final euphoria, a lot of fear of missing out, a lot of speculation is going to start to take over. People are going to get emotional. People are going to forget the fundamentals when it comes to investing and just throw everything out the window and just buy something because it's going up in price, but doesn't necessarily mean that is good value. So we are on the blue marker, and we'll run through these current slides, and hopefully this will give you clarity of where we currently sit. So the Australian GDP growth is quite sluggish. We're coming towards that tail end of the land boom. GDP is quite subdued. A lot of the jobs creation recently have been government funded jobs. I saw the other day actually that there's a statistic about 50% of Australians are dependent on government subsidies, either by way of direct jobs or social welfare benefits, uh, childcare. So 50% are dependent on government support. So hence why there's been a lack of GDP growth and productivity, because 50% of the population's on the government handouts. Australian unemployment rate is starting to trend up. And if you look at history, once it starts to trend up, it will continue to trend up. And then at some point something will break in the system and then it will run, skyrocket. I see unemployment getting to probably 10, 11, 12% come 27, 28, 29 during that next land-driven downturn. But the trend has started. Yes, it's still low in relative terms to over the last 30, 40 years. But what we're looking at is the trend. The trend has started. And if you look back at 40, 50 years of the unemployment rate, you'll see the land-driven downturns and the mid-cycle slowdowns throughout the unemployment rate data, and the spikes will show you when we go through those recessions. So it's started very early days, but it started. And as you can see, if it continues on this trend within a year or two, we'll land in the next downturn. The Australian inflation rate is trending down, has down to 2.7% as of June. This was slightly above the RBA's target for underlying inflation. They had a forecast of 2.6% for the June quarter, so it's come in slightly higher. And anything above 2.7% for the trim mean inflation may make the RBA reluctant to cut the interest rate, according to Westpac chief economist Lucy Ellis. So it is moving in a positive direction, but is not quite at that 2.5% trim mean inflation as of yet. So we are expecting another decision on the rates, cash rate, come the 12th of August in the next 2 weeks. I see them probably holding at this stage. Yes, the data is evolving in the right direction with the unemployment rate going up and inflation coming down. But you'll see in the future slides, the US is going the other way. And I believe the RBA would be reluctant to continue to keep dropping when the US isn't, because that will make a larger gap between our two Reserve Bank rates, which could become an issue for the Australian dollar. If it continues to weaken the Australian dollar, that could also be inflationary. Also, that's come out for the month. Treasury advice to the Treasury accidentally leaked. So independent advice to the Treasury was leaked during the month, which outlines that the Albanese government needs to either raise taxes or slash spending in order to meet the budget. So hence why they've got this roundtable, new tax reforms coming up. Be good to see what happens out of that. But I can expect there to be probably higher taxes in the way of unrealized capital gains tax and potentially even CGT discount. So these higher taxes coming in ultimately will create an even bigger downturn come 27, 28, unless if they can maintain current taxes or cut the current taxes, but it doesn't seem like it's going in that direction, especially with the amount of spending that the current Labor government have been making. The US GDP growth Nothing's changed in terms of data points, but I thought this is quite interesting to keep track of. Q1 is negative. If we get a second quarter of negative, the US will be in a technical recession. So something to keep note of. The US unemployment rate also remains at 4.1, so relatively tight, but again is starting a similar trend upwards. US inflation rate came out for June to date, and inflation rose from 2.4% to 2.7% to June. The US Fed has a target of 2%. So they don't have a target of 2 to 3% like in Australia. So they've got a tighter target to hit, and it's going the other way. So hence why the Federal Reserve is holding the cash rate at 4.5%. And this will be a leading indicator for Australia because ultimately, I believe the RBA will want to more or less mirror what the US does. And if they're not dropping, then we'll probably see our cash rate on hold, as well as the Fed chairman, Jerome Powell, is sticking to his guns, even though Trump is towering over him, trying to get him to drop rates to 1 to 2%. You can imagine what would happen to the markets if that happened. Obviously, he wants low rates. He's a property guy. For every one interest rate cut in the US, it would save them 350 to 400 billion in interest on their federal debt. So massive amount of cost savings they could, but ultimately that would just send the markets off its heels at the final euphoria segment of the 18-year land cycle. So you can see how this policy, if Trump tries to get rates down, it's just going to really charge the markets and send it through that final froth top like a market sees prior to entering a downturn. So the Fed is sticking to his guns. Jerome Powell, that is, he's reluctant to cut rates as he believes that inflation will rebound. It is already rebounding. So with it at 2.7% and their target at less than 2%, I don't see the Fed dropping rates in any time soon. And Trump is lining up a replacement for Jerome Powell come May 2026, and ultimately will put someone in that position that will drop the cash rate. So come early 26, you can see how this is all going to keep feeding on itself. The euphoria, the boom, speculation is just going to be going absolutely bonkers late 2025 and early 26 as people start pricing in further rate cuts into the market. Trump signed a crypto act into law. Again, more euphoria, more speculation. No one really understands or knows where crypto is going. It's never been tested through a land-driven downturn. In my opinion, I think it's going to dust. There's nothing behind it. There's no intrinsic value of what it is. Even the largest investors in the world, like Warren Buffett, don't believe in it. So it's basically more buyers than sellers currently. But when the market turns and people need cash to pay off debts, to maintain their assets, such as property, cryptocurrency will be the first to go. And if there's more sellers than buyers, it'll go to zero because there's nothing behind it other than the blockchain woozy wuzzy. So it's ultimate speculation. And now that Trump is backing it, he's going to draw in more capital from mainstream, and everyone is going to be charging into it, as people typically do towards the tail end of a boom of any type of asset. The mainstream herd charge in at that final year or two of the boom and end up learning the hard way. So I see most people probably losing money in crypto over the next couple of years, especially once the next land-driven downturn sets in. That'll be the ultimate test for crypto, and I see it going to dust. Goldman Sachs recorded record profits and stock prices. So again, this is the credit expansion that happens in the land boom. High credit being created, lended into the market, pushes up real estate prices, pushes up stock markets. Ultimately is coming from these big banks, investment banks. Again, it explains and shows where we are in the cycle. Stock markets are hitting all-time high, even though behind the scenes you can see how the economy is not as strong. Unemployment's starting to rise, productivity is low, but people are still speculating and backing that's going to go on forever, as that's what people tend to do. The mainstream continues to keep buying up, and everyone becomes a genius when the markets are pumping. So again, it is getting to a stage of pretty overpriced and is probably only 12, 18 months away from topping out. Warren Buffett, cash position has hit record approximately 348 billion in cash. He's sitting on, he sees the writing on the wall. He's getting ready, cashed up for when the market turns. Pre-GFC, he was sitting on about 25 billion, I believe. So it's the most he's ever sat on in his entire career, which should tell you something. Ray Dalio also issues a dire warning that the 37 trillion ballooning American federal debt will trigger an economic heart attack. So if you look at into what Ray Dalio talks to, the long debt cycle, he believes that we're due for a large downturn coming, and he can overlay his long-term debt cycle and short-term debt cycles with the 18-year land cycle as well. And it's all correlating to a pretty similar point in time. As you can tell, he believes something big is coming, which is all starting to line up. D.R. Horton, a land and property developer in the US, the biggest in the US. D.R. Horton lost 66% in stock price, share value over 27 months from July 2005 to October 2007, before the entire stock markets all topped out prior to the GFC in 2008, 9, 10. Today, D.R. Horton has lost 24% over 10 months from its peak in September 2024. So this can also be used as a leading indicator, as their reduced earnings will continue to be evolving and recorded over the coming quarters. And as they continue to release reduced earnings, as land price continues to soften, it'll be reflected in their stock price and can be used as a leading indicator for when the overall markets are due to tank. So it has started to pick up in recent month or two, but similar situation happened in 2006. It retraced and then regained some and then continued on its way down through a downturn. So we're keeping tabs on this, and it'll be interesting to see how it pans out over the next 12 to 18 months, as we are 10 months into a decline. So we've got a good 17 months. So it will bring us to the end of 2026. could be the market top. Just a bit of housekeeping. Obviously, this is by no means financial advice. I'm not a financial advisor. This is by no means general or any advice. I don't know who you are or your personal circumstances. This is just my thoughts, my story. If you want help navigating the real estate cycles and buying investment properties to build your portfolio, there's always a market to buy in. So don't be gun shy or scared around this whole land driven downturn that's coming. We use it as a framework to understand where we sit in the market, being in equivalent point of time 2006. Once the market does turn, the likes of Brisbane, Perth, Adelaide, Darwin, respective regions will get hammered. And then the mainstream herd, the demand that's currently going into these markets will come back to Sydney, Melbourne, and Sydney, Melbourne will then lead again in the recovery, just like they did between around 2007, 2008 and onwards for a solid 10 years of bull run. Hence why we are now sowing our seeds in these markets, in certain types of property types, certain price points, certain yields. It's not a blanket rule, just go and buy anything in Sydney or Melbourne and should be right, mate. Certain types of products will get you to being able to join the 1% of property investors who have 6+ investment properties and achieve financial freedom. If you want help, reach out today. Happy to jump on a call to discuss your current position and how we may be able to work together in the future months ahead. Until next time, thanks for watching.